What do you mean by gross value addition? For this, let me give you the basic idea of a value addition in the first place. Value addition done in the system by producing a unit of a raw material or services which are used as intermediary goods or inputs in the whole production chain. I will say, sir, what is this? This is very technical definition. Let me give you a layman understanding of value addition. Imagine you have supplied raw material to me and I am the producer here, and you have supplied raw material to manufacture this particular pen. So what you have done, you have supplied raw material, let's say of 10 rupees to me. So for me, what is the input cost? Raw material cost is nothing but input cost. So I have purchased raw material worth 10 rupees. I have added value. I've changed the shape. I've put it in the production process. And now I've made this particular pen ready. And I'm about to sell this particular pen in the market at 20 rupees. So have a look at this. My input cost is how much? 10 rupees. And my output price is how much? 20 rupees. So in the system, basically in the supply chain or in the production chain, I have procured raw material worth 10 rupees and my output is worth 20 rupees. So how much value I've added in the system, either by producing a raw material or by providing a service or producing a unit of output, whatever the process is. So basically what you need to consider is how much is the input cost, how much is the output price. The difference between these two will give you the value addition done in the system. For example, here output price is how much? 20 rupees. What is the input cost? 10 rupees. So the value addition done to the system by me is 10 rupees. Is it okay? I'll take another example. Let's continue the same. You have supplied raw material to me. I will create a product, right? The raw material cost is 10. So you have supplied raw material 10 rupees to me. I've produced a good and I will sell this at 20 rupees to my friend. Now he will purchase that at 20 rupees and he will also add certain value. He will manufacture some other product and sell it in the market. That's at 50 rupees. So how much is the total value addition? Take the first step here. In the first step, input cost is how much? 10 rupees. And what is the output price? 20 rupees. So how much is the value addition? 10 rupees in the first step. Look at the next step. I have sold raw material or intermediary good to my friend at how much? 20 rupees. So for him, input cost is 20. Output price is 50 rupees. So in the second step, how much is the value addition done by him? 30 rupees. So this is how the value addition is calculated in the system. Is it okay? So value addition is generally done in the system whenever there is a production of a unit of a raw material or a service which are used as intermediary goods or inputs in the whole production chain. At every step, until unless the good or service is sold to the final consumer. What do you mean by final consumer? Final consumer is the one who will use the good, who will consume the good, right? For example, this particular pen, raw material will be supplied by one person. There will be a company which will manufacture it. This particular company will sell the pen to another company that will market it in the market. I will go and purchase that particular pen in the market. I will use the pen. I will become the consumer here. Is it okay? So in case the supply chain happens like this, in the whole production chain, if these events take place, generally at every step there is a value addition because of this. So that is the basic idea of a value addition, and we calculate this particular concept of value addition for overall economy. We'll take it for overall economy. That is the reason we are going to use the term called as gross value addition. I've given a table wherein I'm basically saying that the value addition is calculated in a particular sector. That is, we are going to mine out one of the ore and we are going to convert this particular ore into a product, sell it to the consumer in the market. So in the whole process, how the value addition will take place. Let me give you one example here. Now, either use the term intermediate good or a raw material here. What is the first step? There is a mining of ore. Either take, let's say iron ore, hematite or magnetite are the very important ores with respect to iron. So what is the raw material? Right? Imagine I am the person who is going to mine out the ore. Am I using any raw material? Am I purchasing any raw material in the market? Absolutely no. So value of raw material for me is 0, but I will mine out and imagine I will sell this particular ore to you people. So you will purchase this particular ore from me at 10 rupees. So have a look at this. What is the input cost? What is the raw material cost? 0. What is the selling price? 10 rupee. How much is the value addition? 10 rupee. Now you have taken this particular ore. You have converted this particular ore into steel. You are a steel manufacturer. So for you, what is the cost of raw material? 10 rupee. You have converted this ore into steel and you will sell it to your friend who is an utensil manufacturer at 30 rupees. So in the second step, you will procure the raw material at 10. You will sell it at 30. So what is the value addition you have done in the system? 20 rupees. Now your friend who is an utensil manufacturer, he will purchase this particular steel at 30. For him, the raw material cost will be 30. Now he will convert this particular steel into different utensils, sell it in the market at 50 rupees. So the output price is 50, raw material cost or input cost is 30. What is the difference? Value addition is 20 rupees. So this is how the value addition is calculated. But understand this, rather than doing it at every step, I can do it in another way. That is basically get the sum total of intermediate goods, 0 rupees, 10 rupees and 30, that will be 40 rupees. Get the sum total of total market prices of goods which have been sold in the market, 10 plus 30 plus 50, that will be 90 rupees. Difference between this is the value addition 50 rupees, which is nothing but 10 plus 20 plus 20 like this. So either you can calculate it like this or you can calculate it individually also and get the sum total. But generally NSO basically follows this method. Collect the data from minor steel manufacturer and utensil manufacturer. They will give you the production data. Then calculate how much is the value addition done in the sector. Now I've done this particular calculation for steel sector. Can I do it for aluminum? Definitely yes. Can I do it for textiles? Yes. Can I do it for any of the other goods? Definitely yes. So basically this is how the value addition is calculated for these particular sectors. So value addition is equal to total consumption minus consumption of intermediate goods, or else use a layman term here, raw materials. Done. This is one example. Just to make things much more clear, I've given another example. Just have a look at the table. Same calculation, but this is in a different sector. That's the only difference. There are only 3 steps were there. Right here also 3 steps are there. But basically different sector, the data or numbers are different, but the calculation still remains the same. At every step we have calculated value addition. What is the total value addition? Either this way or you can do it the other way also, right? So same formula will be used here. Now to arrive at the GDP methodology, what we have done so far? GDP, 3 methods. Most important one is production or output method, and we are looking at how we calculate GDP in the production or output method. And under this, what are the methodological changes? One, base year has been changed. Second, earlier we used to collect the data, production data from ASI. Now we have shifted to the MCA 21. Third one, earlier we used to calculate GDP using the cost prices. Now we are using market prices. Earlier we used to get the production data using IIP also, right? Index of Industrial Production, which gave us a change in the volume of production. But now we have shifted to usage of a concept of a GVA, gross value addition. So far, these are the 5 very important methodological changes which we have discussed. Now, before I tell you how actually GDP formula is used or how GDP is calculated using a formula, I want to tell you 2 very important sets of concepts. Right? One is the idea of a taxes and the other one is the idea of a subsidies. Now, if you remember earlier, I basically used this particular formula. I had started from cost prices, then there was indirect taxes, and then there was subsidies like this to arrive at market prices. Is that okay? But within this, there is one very important change here. The new methodology says these indirect taxes that I have written here are of 2 types. These indirect taxes are of 2 types. These subsidies are of 2 types. Indirect taxes, one, I'll simply write production taxes and product taxes. Is it okay? Production taxes and product taxes. And second, subsidies, production subsidies and product subsidies. I'll explain to you what is the meaning of each of the term. Now, before I go any further, just understand the difference here very carefully. Whenever you use the term product, either for taxes or subsidies, is it okay? Because we have used product taxes and product subsidies under both the heads. Whenever I use the term product, simply remember this. This either tax or a subsidy, that is either tax is paid or subsidy is received, both are connected to volume of units produced. I'll repeat it again. When you say product, either taxes or subsidies, taxes are paid, subsidies are received. So whether you pay product taxes or receive product subsidies, both are connected to volume of units produced. Let me give a very simple example. Imagine I'm manufacturing this particular pen using environment-friendly plastic. That is a biodegradable plastic. Obviously, Government of India would want to promote it. Or else, let me take another example. Electric vehicles. So, Government of India is pushing the production of these particular electric vehicles. Now, imagine Government of India says, if you manufacture one electric scooter, Is it okay? If you manufacture one electric scooter, I will give you a subsidy of 10,000 rupees. It is telling the manufacturer. Imagine you are the manufacturer, I am the government. Again, imagine this. I will tell you, you produce one unit of a electric scooter, I will give you 10,000 rupees a subsidy. In essence, what I'm saying, you produce one, 10,000 rupees I'll give you. You produce two, I will give you 20,000. You produce three, I will give you 30,000. If you produce a 10, I will give you 1 lakh rupees subsidy. So in this particular example, can I simply say that how much subsidy you receive is connected to number of units that you are producing. If you produce more, you will receive more subsidy. If you produce less, you will receive less subsidy. If you don't produce, you will not receive any subsidy. Then, on the other hand, there is a concept of a product taxes. Again, directly linked to volume of production. Government says, you produce one unit, I will charge you 5 rupees GST. This type of example. You produce one unit of a product, I will charge 5 rupees of taxes or 5 rupees GST on you. So, if you produce one unit, how much will be the GST? 5 rupees. 2 units, 5 plus 5, 10. 3 units, 15. 4 units, 20, 10 units, 50, 100 units, 500. Now, can I simply say that these particular taxes are directly connected to how many units you will produce. If you produce one, 5 rupee, 100, 500 rupee. If you don't produce, obviously no taxes. So understand this, within the concept of the taxes and subsidies, there are two types, product and production. Product, either taxes or subsidies. Taxes will be paid, subsidies will be received. So when I say product taxes, these are the taxes which are paid by the manufacturers or the market participants based on volume of units produced. Product subsidies received by the market participants based on volume of units produced. It's always connected to volume of units. Whereas on the other hand, production taxes, production subsidies. Let me continue with the same example. You are the manufacturer of electric vehicles. Now, even before you set up this particular electric vehicle plant, is it okay? You are about to set up this particular plant. Government will tell you, I will give you 30 lakh rupees subsidy. So, have a look at this. Government is telling you, I will give you 30 lakh rupee worth of a subsidy so that you can set up the manufacturing facility. Now, can I simply say that this 30 lakh that you will receive to set up your manufacturing facility has no connection with how many units you produce. You produce or you have a capacity to manufacture 100 units, you will receive 30 lakh. You have a capacity to manufacture, let's say 1000 units, then also you will receive 30 lakh rupees. So these particular subsidies, production subsidies, are independent of volume of production. These are independent of volume of production. You will receive these particular subsidies which is not connected to volume of production. For example, fertilizer subsidy, electricity subsidy. Generally, these kind of subsidies which are given by the government are not connected to the volume of production. On the other hand, production taxes, these are the taxes which are paid by the manufacturers which are independent of volume of production. Example, professional taxes, property taxes, so on and so forth. Same thing I've given in the explanation here. Production taxes, land revenues, stamps, registration fees, professional taxes, etc. Again, no connection to volume of production or independent of volume of production. Production subsidies, subsidies to railways, input subsidies to farmers, subsidies given to small industries, subsidies given to companies, etc. Product taxes and product subsidies, excise duty, sales tax, service tax, import and export duties directly related to the number of units. Product subsidies, petroleum fertilizer subsidies, interest subsidies given to farmers, etc. Right? So these are some of the types of the product taxes, product subsidies, production taxes, production subsidies. Should you remember all of it? My recommendation is remember the concept. Concept is very, very important here. What is the concept here? Whenever I say product, either taxes or subsidies linked to volume of production. How many units you produce? When I say production, taxes or subsidies independent of units produced, or it is not dependent on number of units that you produce. Now, last concept to understand to calculate GDP is the concept of basic prices. What is the basic price? It is the amount which should be received by the producer for the product minus any tax on the product and plus any subsidy on the product. Now, what do you mean by this particular statement? Let me give a simple example. Imagine you're manufacturing this particular pen. Let's start an example. You're manufacturing this particular pen. So obviously for raw material, labor, so on and so forth, you would have incurred a cost of 30 rupees. Is it okay? You would have incurred a cost of 30 rupees. So when you sell in the market, understand this, when you sell in the market, you would want to receive at least 30 rupees. Again, yes, I know there is a taxes, so on and so forth. We'll come to that. So if you have paid or if you have incurred an expenditure of 30 rupees to manufacture this particular pen, you'd want to sell it in the market at least 30 rupees. Again, don't say, sir, what about profit? Input cost is already inclusive of profit. But what this GDP methodology says is, no, that is not correct. You would not want to get 30. You would want to get more than 30. Why? Follow this very carefully. To manufacture this particular pen, you would have set up a facility, a manufacturing facility. To set up manufacturing facility, you would have already paid certain indirect taxes. What kind of taxes? Production taxes. Imagine you have paid production taxes worth 5 rupees. What does it mean? Even before you manufacture the pen, you have already paid certain taxes of 5 rupees. So understand this very carefully. Whatever these kind of taxes, these means indirect taxes, any type are paid by the manufacturers. These particular indirect taxes will be collected back by these particular manufacturers from consumers. Is it okay? I'll repeat the statement again so it is clear to you. Whatever indirect taxes are paid by these particular manufacturers in the whole chain, in the whole supply chain, none of them will pay the money from their pocket. What they will do is they'll simply collect it from the consumers overall. For example, imagine here is a manufacturer. He has paid a 10 rupee indirect tax to government and the cost is, let's say, 100 rupee. Do you think this particular 10 rupee that the manufacturer has paid to the government, he'll pay out of his pocket? Absolutely no. When he will sell the product to you, he'll simply sell the product at 110 rupees, out of which 10 rupees nothing but the tax that he has already paid to the government. Is it okay? So whenever there is a concept of indirect taxes, remember this. The manufacturer or the supplier in the system will simply transfer that to the consumer, collect it back from the consumer. So here is the example where I'm saying you are the manufacturer, you are incurring a cost of 30 rupees to manufacture this particular pen. That is an input cost or cost price for you. But before manufacturing this particular pen, you have already paid certain production taxes such as professional tax or land registration fees, so on and so forth. Now, because you have paid these particular production taxes, don't you want to collect it back from the consumer in the market? Definitely yes. So what this concept of basic prices says is, you'll have to consider cost prices or you'll have to consider factor cost. I'm using two terms, both are one and the same. Cost prices or factor cost. In addition to this, there are production taxes which you have already paid to the government. In addition to production taxes, you must have received certain production subsidies also. For example, subsidy on electricity. Is it okay? You must have received certain production of subsidy also. This is independent of the units that you produce. So on one side, you have paid production tax. On the other hand, you have received a production subsidy. So have a look at this. The factor cost plus production tax minus production subsidies is referred to as basic price. This is referred as basic price. Now look at the statement. It is the amount which should be received by the producer for the product minus any tax on the product. Any tax on the product is, let's say, GST. We have not yet calculated that. That is not there. And plus any subsidy on the product. We have not received any of the product on the subsidy, so I have not calculated here. So this concept is called as a basic price. What is the formula? The factor cost plus production taxes minus production subsidies. That is the concept of a basic prices. Done? So I'll put everything in a nutshell now. GDP, three methods. We are focused on production method. What are the important changes? Base year is 11, 12. From factor cost or cost price, now we have shifted to using the concept of a market price. We have changed how we collect the production data also. Earlier we used the concept of ASI, Annual Survey of Industries. Now we are using MCA 21. Earlier we used IIP. Now we are using the gross value addition method. And we also seen what is the concept of a production tax, production subsidy, product tax, product subsidy, and basic prices. Once you have understood all of this, now I'll put everything in a nutshell as to how NSO will use all of these concepts to calculate GDP through production or output methodology. Start from the right hand side. You don't have to mug up the table. For you, this is important. So GV at a factor cost. Obviously, that is factor cost is nothing but an input cost substitute. So GV at a factor cost. To this, we add production taxes and production subsidies. Net means production taxes, that is a plus, minus production subsidies. You will arrive at a GV at basic prices. Shift to the right side now. We are GV at basic prices. That is basically the price that the manufacturer is supposed to receive. That is not accounting for product tax and product subsidies. So to this, add product taxes as well as product subsidies. What you get is GDP at market prices. Now, rather than mugging up this particular table, you can remember these two formulas. GV at basic prices is equal to GV at factor cost plus production taxes minus production subsidies. Again, you will use GV at basic prices here. You will add product taxes, subtract the product subsidies. You will get GDP at market prices. Market cost or market prices. You will have to remember these two formulas. Please mug up these two formulas. Again, from where you are supposed to start? Factor cost. There are four factors. Obviously, companies will incur a cost on this. That is called as a factor cost. Start from the factor cost. To this, we are supposed to add a production taxes minus product subsidies. You will get basic prices. So the basic prices, you will have to add product taxes minus product subsidies. You will get GDP at market prices. Done. So this is how the GDP is calculated under output or product method or production method. Remember this. This is important. Hence, we have discussed this in detail. Now, what has been the issue with respect to this particular methodology? This particular methodology has been introduced from 2014 and 2015 by the government, and post that every year once or the twice or more than that, there has been certain issue with respect to this particular GDP estimation methodology. What is the issue at hand here? Have a look at this. The concerns related to this particular methodology is that under this particular methodology, it says that GDP growth rate is, let's say, 6%, 7%, 6.8%, so on and so forth. But experts are saying if GDP is so high, then why it is not getting reflected in other macroeconomic parameters? Now you'll ask me, sir, what is the meaning of macroeconomic parameters in this particular context? Have a look at this. If GDP is increasing, let's say by 7%, it simply means what? The total market value of goods and services has increased. The production has increased. So don't you think when the production increases like this in the market, the total amount of profits which are registered by these particular companies or profits earned by these particular companies should increase. The repayment of loans to the banking sector should also increase. To produce more goods and services, you'll require more electricity. So demand or consumption of electricity must also increase. And more importantly, employment should also be generated. So here is the argument. On one side, you say that as per the new methodology, GDP is growing by 6%, 7%, so on and so forth. But the NPAs, non-performing assets, we'll discuss that separately. NPAs in the banking sector has increased. Credit offtake, that is loans given by banks to industries, is getting affected. Employment generation is getting affected. The consumption of electricity and demand for electricity is affecting. So, what is this particular issue here? On one side, GDP is increasing, but that is not being reflected in these particular parameters because both of them should be moving in the same direction like this. That is the argument. That is the precise reason. There is an argument that there is an overestimation in the GDP. As per the former CEA, Mr. Arvind Subramanian, he basically stated that this particular GDP, what we are estimating right now through production methodology, is overestimated by 250 basis points, or in simple terms 2.5%. Remember this, 100 basis points is equal to 1%. So 250 basis points is equal to 2.5%. Is it okay? So as per the survey or as per the studies done by this particular person along with other experts, their conclusion is that if government of India says we have achieved a GDP growth rate of 7%, it will not be actually 7%. It will be 7% minus 2.5%. That is 4.5%. So these are some of the concerns which have been raised with respect to the GDP estimation. So countering this, the last year's economic survey has come out with a study or detailed study on this particular GDP estimation and what is the methodology in other countries. Are there any similarities or dissimilarities? The economic survey basically defends the data or defends the production data which has been published by the government. Their argument is, yes, you have studied, but you have assumed that there is always a positive correlation between these parameters and this. That is, you're always assuming that increased electricity consumption, increased exports, imports, increased labor, so on and so forth, always are related or always will move in the same direction with GDP. That is, GDP growth rate increases, then these also must keep on increasing. But the analysis which has been done by the economic survey has shown that majority of the countries which are considered for this particular analysis, in those countries, once every 3 to 5 years, that is, analysis has been conducted between 1980 to 2015, once every 3 to 5 years, this particular correlation that exists between employment, electricity, loans with GDP, this correlation will flip flop. That is, basically in the first 3 years slot, both these particular groups are moving in the same direction. In the next 2 to 3 years, these two particular groups might be moving in opposite direction. That is, GDP keeps on increasing, employment generation, loans, so on and so forth, they might decline. So this kind of a correlation is not a constant throughout the period. This correlation will keep on flipping and flopping like this, right? So that is the counter argument which has been put forward by the economic survey in favor of the GDP estimation data. And moreover, understand this, the government of India itself has clarified it is not the government which is publishing the data, it is one of the arms of the government. It is one of the entities or one of the institutions which have been set up by the government of India. And this entity has been publishing the data, and this is the entity which has changed the methodology and not the government per se. So these are some of the points with respect to GDP estimation debate. Next concept, the concept of a GDP deflator. Now, before I wind up GDP, I just want to tell you about the concept of a GDP deflator here. Understand this very carefully. I say that whenever we calculate GDP, there's a concept of a base year. As of now, which base year are you using? 2011 and 2012. Now, from the base year to the current year, obviously the market prices would have increased. And one of the reason for this particular increase in the market price is the inflation. And what is inflation? I've already given you a basic definition. Inflation refers to increased price level of basket of commodities. So if the price levels are increasing, or if the price of the commodities are increasing because of inflation, that does not reflect the value addition done in the economy. I'll repeat the statement. If the price levels are increasing from one year to next year, this is not because of a value addition in the system, rather it is happening because of inflation in the system. So what we do is we try to take out the impact of inflationary trend in the market, specifically in the GDP calculation. For this, we use a deflator, or we use an aggregate which is referred as a GDP deflator. I've given the formula here. GDP deflator is equal to nominal GDP divided by real GDP. Understand this, in case of India, the GDP deflator that we are using is a wholesale price index, WPI. Just a nugget here, just a point. Inflation is measured under two heads. So one is called as a CPI, consumer price index, and the second one is a WPI. Now, as of now, simply understand this. In case of a WPI, we measure the price changes, the price level changes in the wholesale market, whereas in case of a CPI, we measure the price level changes in the retail market. This is one very important difference. Now, if you ask me, sir, what is a wholesale and retail market? In case of CPI, we are measuring the price levels in the retail market, means where we are purchasing the goods and services. Whereas in case of wholesale market, generally it is a market where goods are sold and bought in huge quantities. Right? So understand this. In case of a WPI, second very important difference is it does not include any of the services. Whether the prices change of services or not, it is not included in the services. Whereas in case of CPI, yes, both the goods as well as services are considered. Now, more than sufficient as of now with relation to this, because we'll study both of them in detail when I take up inflation. But come back to the point at hand here. I said that from the base year to the current year, or from the last year to this year, the prices of the goods would have increased in the market, and this does not reflect the value addition that is done in the system. So what we generally do is we'll try to take out the impact of inflation on this particular market price, and that aggregate that we use to take out the effect is nothing but GDP deflator. Now, as of now, we are using a GDP deflator such as a WPI, but please understand the best indicator or best deflator that is used in a majority of the countries, definitely in the developed economies, is referred as a producer price index. I'll discuss with respect to this. Just give me a minute. Now, some of you will basically look at this and say, sir, you say that GDP deflator is used to deflate the data, used to reduce the impact of inflation. But you're basically calculating GDP deflator by taking nominal GDP and real GDP. And if you remember, what is the concept of a nominal and real? Nominal is the GDP which is calculated based on taking into consideration the current market prices. And real GDP is calculated taking into consideration the base year prices. But how it is possible? We must get the GDP deflator first, then we can go to the constant prices or base year prices. Please understand this. Generally, deflator is put this side and real GDP is put this side. That is, real GDP is equal to nominal GDP divided by GDP deflator. This is the actual formula. That is, whatever is the GDP, market price of all the goods and services, based on the current market prices, divide that or take out the impact of inflation on this, we will arrive at GDP at constant prices or GDP at base year prices. Okay, or real GDP. This is the actual calculation. Now, next very important point, I said that in developed economies, they're using a concept called as a producer price index. Now, what do you mean by producer price index? In case of a producer price index, what generally they do is, imagine here is a manufacturer. This particular manufacturer is selling certain goods in the market. Now, what is the change in the price level of these particular goods? Have a look at the statement here very carefully. In case of a producer price index, what they do is they will measure over a period of time by what percentage these particular prices at which manufacturer is selling the goods in the market has changed. I'll put in a definition form. Producer prices index measures the percentage change in the prices of the goods which are sold by the manufacturers in the market. Over a period of time, the goods which are sold by the manufacturers, the prices would have changed. So compared to base year, today, how much is the change in the price that is sold by the manufacturer here or supplier in the market is calculated. This is called as a producer price index. Now you'll say, sir, what is the difference? How it is better? First and foremost, understand this. In case of the CPI, CPI is what? Retail inflation. It is at the market level, at the market where we are consuming or where we are purchasing the goods and services. If I take into consideration CPI and use it to deflate the nominal GDP, that is the GDP at current market prices, the issue here is the CPI is derived or CPI is arrived at after accounting for the indirect taxes which are imposed by the government. Is it okay? Means what? The market prices that we are paying are inclusive of indirect taxes imposed by the government. So there is an impact of indirect taxes on the CPI. First one, if I take WPI and start deflating the numbers using WPI, there is another issue. WPI does not consider service prices itself. So there is a problem with respect to both of these particular indicators being used as GDP deflators. That is the reason producer price index, which basically measures the change in the price level at the manufacturer stage itself. Because obviously, once he calculates, let's say, the cost of price, there is addition of indirect taxes, so on and so forth. So at the manufacturing stage itself, if you calculate what is the change in the price level, that is much better indicator of a change in the price levels in the market. That is the reason in developed economies, they are using the concept of a producer price index. In India, Government of India has set up a BN Goldar committee. This particular committee has given certain recommendations. They have basically asked Government of India to prepare the producer price index using the supply use tables of 2011 and 2012. Now, what is a supply use table? Follow this very carefully. In case of Indian economy, we will import certain raw materials, and there are certain raw materials which are present in the domestic market itself. Is it okay? This is a domestic supply of raw material, and this is imported raw material. These particular raw materials will be allocated or will be sold to different industries like this. For example, aluminium, steel, so on and so forth. We get it from the domestic market as well as we import it also. So understand this. We'll get these particular intermediary goods or raw materials from the domestic market as well as from the import also, and we'll supply that to industries like this. This table which maintains the details of all of it. The table which maintains the details of all of this is called as a supply use table. So BN Goldar committee has recommended that we must use supply use tables of 2011 and 2012. Second, we must prepare two sets of PPEs, one which includes services and the second one which excludes the services. And the PPE which includes the services, they have recommended a list of 15 services. We must include these particular 15 services within this. Next, over a period of time, the PPI producer price index will replace wholesale price index as a GDP deflator. But before that, this particular PPI must be stabilized. Next, the experimental PPI will be published on monthly basis, and initially for the calculation of PPI, the base year would be 2011 and 2012. So these are some of the very important recommendations which have been provided by BN Goldar committee with respect to preparation or with respect to preparing producer price index in India. Now, having done with GDP, let's look at some of the other aggregates. Just to put in a nutshell, we have seen GDP. Other aggregates are GNP, gross national product; NDP, net domestic product; NNP, net national product; and the last one will be national income. So these are the different aggregates. Now let's look at the next one, gross national product. Now, first and foremost, understand this. When we discuss GDP, what is the concept? What is the total market value of goods and services which are produced in India? But in the context of a gross national product, understand the concept here. In case of a gross domestic product, focus on the second term here, domestic. So the production should have happened in the Indian territory. Whereas in case of a gross national product, again focus on the second term here. National simply means the goods and services which are supposed to be produced by the nationals of a particular country or residents of a particular country. So that is the basic idea here. In GDP, we are considering total market value of goods and services which are produced in India. Whereas in case of a gross national product, we are considering total market value of all the goods and services which are produced by the residents or the nationals of a particular country within a particular financial year. Now understand this. When I say nationals, I could consider citizens or residents of a particular country. Generally, the definition for using a resident in the calculation of GDP is if he is there in India, imagine for a period of less than 1 year, there's a foreign national is there in India for a period of less than 1 year, then he is not considered as a resident of India. In the same way, if an Indian goes abroad to stay, work, and send back the money or bring in the money back to India, for a period of up to 1 year, generally he is still considered as a resident of India. So idea is when I say national, I can consider the citizens, I can consider the company also. For example, a particular company would be operating in USA also. And when it operates in USA, it's an Indian company, but it is operating in USA, generating revenue there. As long as that is an Indian company, any revenue that is generated by an Indian company, despite staying outside India or despite functioning outside India, that revenue will be part of India's GNP. Remember the difference here. If there is an Indian company, it works in USA, generates profits. Should it be part of India's GNP? Yes, because it is an Indian company. Irrespective whether it is generating profits in India, Bangladesh, UK, Germany, USA, doesn't matter. That is an Indian company. Since it is an Indian company, I will consider that as a part of India's GNP. But will I consider that as a part of India's GDP? Absolutely no. This Indian company, if it generates revenue, profits in India, yes, it becomes part of India's GDP. But if it is generating in India as well as in USA, the one that is generated in USA will not be considered as India's GDP. Is it okay? So understand the difference here. Gross domestic product. Production should have happened in India. Gross national product. It should have been produced by Indian nationals. So how do I derive a GNP here? We already know the concept of a GDP, gross domestic product. Now we'll use the concept of a GDP itself to derive a GNP. Now follow the equation here. When I say GDP, can I simply say this? GDP consists of production done by nationals of India who are living in India. Is it okay? Indian nationals who are living in India, and also considers the production done by foreign nationals. Imagine this is India. I know this is not India, but imagine this is India. Here are two individuals, A and B. Imagine A is an Indian national. So obviously whatever production is done by him or this company will be part of India's GDP. It is living in India or it is there in India, producing in India. And since this particular company is operating in India or this particular person is there in India, he is earning, it will be considered as part of India's GDP. As long as it is produced in India, it will become part of India's GDP. But here comes the second concept, GNP. In case of a GNP, I should consider only Indian nationals. So when I say GDP, this is the total production done by both A and B, or total income generated by both A and B. It is part of India's GDP. But can B be part of, that is this particular component be part of India's GNP? Absolutely no, because this is produced by a foreign national. So understand this, we already know the concept of a GDP. Using GDP, we'll calculate a GDP. Using GDP, we'll calculate GNP. Now, what is the adjustment done here? GDP plus NFIFA. I'll elaborate on this. Follow this very carefully. NFIFA stands for Net Factor Income from Abroad. I'm using the acronym NFIFA. Some of the books will simply write it as NFIA. That is the Net Factor Income from Abroad itself. Either NFIFA or NFIA, don't get confused. But essentially, what is the meaning of NFIA or NFIFA? Let me give a very simple example here. Imagine this is India. Okay. Now, in India, assume this is the particular person who is working. A is working in India. So, any income generated by this particular person A, can I simply say it is a part of India's GDP? Yes. A has a son or daughter, whatever it is, B. B is not working in India. B, let's say for a period of 6 months or 7 months, has shifted to USA, is working in USA. Will the income generated by B be part of India's GDP? No. But can it be part of India's GNP? Definitely yes. The production done by A as well as B will be part of India's GNP, but the production done by only A will be part of India's GDP. Because A is producing in India, so part of India's GDP. A is producing in India, part of India's GNP. B is producing outside India. Production is done outside India, so not part of India's GDP. But B is an Indian national. So irrespective of whether they are producing it within India or outside India, it will definitely be part of India's GNP. Is it okay? So in the same way, companies are there. They would have produced goods and services outside India. Will they be part of India's GNP? Definitely yes. They would have generated certain profits outside India. Will it be part of India's GNP? Definitely yes. In the same way, there are certain foreign companies which are present in India and they are producing in India. There are foreign nationals who are present in India, they are producing in India. Can this particular production, can this particular salary or wages be part of India's GNP? Absolutely no. So what I have to do is, I'll have to calculate the factor incomes like this. The compensation earned by the employees. The Indian citizens who have moved outside India, they are earning compensation and they will come back to India, let's say within 1 year. So this will become part of India's GNP. But at the same point of time, there are foreign nationals who are working in India for a shorter duration, let's say 3 months, 6 months, whatever it is. They are also earning salary. So can this be part of India's GNP? Absolutely no. So have a look at this. Imagine this Indian who has moved outside India is earning, let's say $500. And this particular foreign national who is working in India has earned $300. So I will have to add this. I'll have to subtract this. Is it okay? Because this is already part of India's GDP. When I calculate GDP, this particular $300 is already present. But this is not done by Indian national. So subtract $300 and add $500, which is a compensation earned by Indian citizen but living outside India. Okay? In the same way, there will be certain properties owned by Indian companies or Indians outside India. And these particular properties can be given on rent, on lease outside India. So there will be certain rent generation on these particular properties. But these particular properties are owned by whom? Indian citizens or Indian nationals. So it should become India's part of GNP. Second point. Third, these particular companies, Indian companies, are operating in India as well as outside India. In the same way, foreign companies are operating in their respective countries as well as in India. So we'll have to consider how much is the net income from the entrepreneurship. That is revenue generated by Indian companies outside India and revenue generated by foreign companies in India. Get the net income. And finally, profits which are generated by resident company, Indian companies by operating outside India and foreign companies by operating in India. Get the net of both of them. So net retained earnings of resident companies abroad. So if I consider all the three, I will arrive at NFIFA, net factor income from abroad. Again, you don't have to mug up all of this. The concept itself is factor incomes. Factor incomes means what? Any labor provided by India to outside world. Factor incomes. Same way, outside world would have provided labor to India. They would also generated income. So subtract the foreign labor income generated in India. Add the labor income which is generated by Indians but outside India. So factor incomes. Companies will generate profit income, right? So factor incomes get the sum total of factor incomes coming from rest of the world to India minus factor incomes which are flowing from India to rest of the world. That will give you net factor income from abroad. So this is how we calculate the gross national product. Next one is a concept of a net domestic product, NDP. What is this particular concept of a NDP? Follow this very carefully. There are two terms here. One is called as a gross and the other one is called as a net. What is the basic idea here? Whenever you come across the term gross, it simply means the sum total. No adjustments are done, no addition, no subtraction is done. You are simply taking the sum total like this. But when you move from gross to net, we are basically making certain adjustments. Notice this adjustment. Follow this very carefully. In case of India, there is a concept called as a depreciation. Again, it happens in every economy. Now, question is, what is depreciation? Depreciation basically is the expenditure in the form of a lower value of the machinery, repairs, etc. Let me give a very simple example. Imagine here is a manufacturer. He is producing a particular good and selling it at, let's say, 15 rupees. That's a market price here. Okay. But can I simply say that part of the market price would have been arrived because there is repairs and maintenance incurred by the manufacturer. Imagine you are a manufacturer. You are manufacturing this particular pen, but in the process of manufacturing the pen, the machine broke down. Machine went into repairs. And repairs means expenditure, cost. So when you repair that particular machine, you would incur certain expenditure on that. Who should pay for that particular expenditure? Again, go back to the basics there. Earlier, I've told you any cost incurred by the manufacturer will simply transfer it to consumer. So, can I simply say that the cost of a machine maintenance, repairs, so on and so forth, is a component of a market price? Second, you're using a particular machine. After 10 years, you will have to replace this particular machine. Now, to replace this particular machine, again, you will have to incur certain cost. So, to incur this particular cost, imagine you have paid X amount of rupees. Who will have to pay this particular X amount of rupees? This X amount of rupees will be transferred to the consumers whenever the market prices are arrived at. So, that is a basic idea. Depreciation is nothing but the expenditure in the form of a lower value of the machinery, repairs, etc. And whenever you arrive at a market price, it is already inclusive of this particular idea for depreciation. But depreciation does not account for the value addition done in the economy. That is a precise reason. What we do is from GDP. GDP is nothing but market prices or total quantity into market prices. And within this particular market prices, there is a depreciation amount. So what we do is to arrive from the GDP to NDP, we will basically deduct this particular depreciation. Now, please understand the value of a depreciation, the policy of a depreciation, the percentage of depreciation will vary from one country to another country. Generally, the depreciation value is decided as per the accounting principles followed in that particular respective country. So, net domestic product is basically calculated by subtracting the value of a depreciation of a capital assets of the nation, such as machinery, housing, and vehicles, from the gross domestic product. If you want to find out what is the definition of NDP, NDP is the total market value of goods and services produced in a particular country for a particular time period after accounting for depreciation of capital machinery in that particular economy. So this is another concept of a national income aggregate. Now using all of this, there is a last concept, and after that we are going to derive national income from NNP itself, net national product. Now, first and foremost, understand this. We already discussed what is the meaning of a net. From gross, we are deriving net. There has to be certain adjustment. And we also discussed a concept of a national. Means what? A total production done by nationals of a particular country. Now, what do you mean by net national product? It is a market value of all the goods and services which is produced by nationals or residents of a particular country in a specific time period. Is it okay? Residents of a particular country in a specific time period. Territory is not important here. whether it is produced in India or outside India, as long as it is done by residents of a particular country, it will be considered as a part of a net national product itself. But not just this. Since I am saying net, you will have to deduct depreciation from this particular GNP concept itself. That is total production done by residents of a country minus the depreciation value. Now, given this particular formula, some of the books will write it like this also. Do not get confused. GDP plus ENF IFA minus depreciation. Doesn't matter, one and the same. I have written this in the form of GNP minus depreciation. You will arrive at net national product. So this is the another very important national income aggregate. The last national income aggregate is NNP at a factor cost, which is also referred as national income. Now, what is the idea of a national income? Follow this very carefully. National income is nothing but the purest form of income. National income is nothing but market value of all the goods and services produced by citizens of a country in a particular year at a factor cost after accounting for depreciation. This concept is basically the national income. And you can understand this. When I say factor cost, there is also accounting for indirect taxes as well as subsidies. You will basically be confused as to what actually I am speaking. I'll take you back to the basic definition. I started with the concept of a cost price. I said that cost price, another way to say cost price is also factor cost, four factors of production. On that, there is expenditure, that is nothing but the factor cost. In addition to this, there is indirect taxes imposed by the government and subsidies provided by the government. And we arrive at what? Market prices. Is it okay? Now, use the same formula, transfer this as well as this to the other side. Can I simply write like this now? Factor cost is equal to market cost or market price minus indirect taxes plus subsidies. Now, rather than simply writing factor cost, I am considering the production done by nationals of a country after deducting the depreciation. That is nothing but NNP. Is that okay? Production done by the nationals of a country after deducting depreciation, that will be NNP at a factor cost is equal to NNP at a market cost minus indirect taxes plus subsidies. This is the formula that we are arriving at. So NNP at factor cost, this is nothing but the purest form of the income is NNP at market prices minus indirect taxes plus subsidies, right? This is called as a national income. So these are the five income aggregates. The most important for you from the context of UPSC exams will be the concept of a GDP. Now, using national income aggregates, there is a concept of a per capita income. What do you mean by per capita income? Per capita income is nothing but the national income divided by the population. And we already calculated how to derive national income or how to calculate national income. Just now we have seen NNPAT factor cost is nothing but national income divided by mid-year population will give you per capita income. Now, what do you mean by per capita income? Per capita income is nothing but it's an average income of a citizens of a particular country. Average income of a national resident or a normal resident of a particular country is called as per capita income. For example, imagine there are three people in a particular country, A, B, and C. 100, 200, and let's say 600. Okay, these are the incomes which have been generated by these three individuals. So total income generated by these particular residents will be how much? 900 rupees. And how much is the population? 3. So the per capita income will be 300 rupees for this particular population. Understand this, per capita income many of the times is used as a proxy for quality of living or increased standard of a living of a particular population. That is, if per capita income keeps on increasing, it is generally used an indicator to show that, see, standard of the people is actually going to increase. Quality of living is actually going to increase. But please understand this, there are certain issues with respect to idea of a per capita income itself. For example, have a look at this. It is just an average number. What do you mean by this? If you remember the earlier calculation that I had done, A had earned how much? 100. B had earned how much? 200. And C had earned 600 rupees. And the per capita income that we derived was how much? 300 rupees. But here is the issue. There is only one person who has earned a substantially very high compared to per capita income. And second point, it doesn't mean that If the PCI is 300, doesn't mean that every Indian is earning 300 rupees. In case of India, the situation is that there's a large chunk of population which is earning much lower than the per capita income. And on the other hand, there is a very small population which is earning much higher than the per capita income. So when you arrive at a per capita income or a data related to per capita income, yes, it is the average income earned by the Indian. That doesn't mean that all of us are earning this particular income. It's just an average. It doesn't represent the actual situation at the ground. Second, does not provide information about the contribution of various sectors. Yes, we have considered all these particular contributions of various sectors, but how much is the contribution from urban India, rural India, from this sector, that sector, or industry? Can we derive that particular information from the per capita income? Absolutely no, that is not possible. Third, many of the times I said a per capita income is used to represent or is used as a proxy for standard of a living. But the counter argument is the standard of living is affected by how government of India incurs expenditure also. Right? For example, have a look at this particular example here. A, B, and C. In this, A and B are running much lesser than the per capita income. But do you think this particular per capita income will represent a quality of a life or standard of a living for both A and B? No. For a simple reason, what if government of India is supplying free electricity to both A and B? What if government of India is supplying free LPG to these particular people? Transportation is subsidized, education is subsidized, healthcare is subsidized, so on and so forth. So how the government incurs the expenditure, that will also have a direct impact on the quality or a standard of living. So per capita income cannot be used as a proxy for a standard of living. It usually represented in the dollars and does not provide the picture about purchasing power in individual countries. What do you mean by this? Whenever we compare the purchasing power in different countries, generally we use a terminology called as purchasing power parity. And this actually will give you a better idea as to what is the power of a purchasing of different consumers in different countries. Now, what do you mean by purchasing power parity? Have a look at this. Imagine for a basket of goods and services, common basket of goods and services. In India, we need to spend 100 rupees to purchase this. For the same quality of goods and services in USA, if they are spending $2, then based on the purchasing power parity, will come to a conclusion that $2 is equal to 100 rupees, then $1 is equal to 50 rupees. This concept is called as a purchasing power parity. That is, to get access to the same standard of a living or quality of a lifestyle in different countries, how much should be the money spent? That is the purchasing power parity. As per the purchasing power parity in this example, $1 is equal to 50 rupees. But when we calculate the per capita income, that particular per capita income, when it is given in the form of a dollar, the current exchange rates are used and not this particular purchasing power parity, which is a better measure to indicate the standard of a living or quality of a living across many countries like this. So these are certain issues which are plaguing the idea of a per capita income. And finally, what are the limitations of national income aggregates? First, collection of data is a headache. Very difficult to collect real-time data in India. Like I already have said, large number of companies in India or large number of units in India are unorganized, informal in nature. So collection of data is a problem. Second, time lag. That is basically we collect the data, let's say for the month of January, February, March, and by the time we publish the results of it, many more months would have already passed. So there is a time lag, that is essentially the data for which we are going to publish the result. There is a long time gap between that and the present situation. There is the existence of non-monetized consumption. That is basically there is an idea of the goods being exchanged for certain services in rural India, especially in the agriculture sector. This is basically referred as a non-monetization. Non-monetization means you do not get the actual market value of these particular goods or services. So until unless you get the market value, how can you convert and calculate that as a part of India's GDP? Right. So there is a problem with respect to this. There's a parallel economy, that is a black money circulation is very high. And whenever there's a black money circulation, accounting for GDP using income method will be very difficult. It doesn't consider the impact of a development, the impact of the industrialization on the environment, so on and so forth. So these are certain limitations which are associated with national income aggregates. Now finally, some of the facts, just factual information. The first estimate in case of India was given by Dadabhai Nauroji in 1861-68. First scientific estimate was given by Professor V. K.R.V. Rao in 31 and 32. First official estimate was given by Ministry of Commerce in 48 and 49. Calculation right now is done by NSO, and the base year that is used is 11 and 12. Now, this is a discussion with respect to national income aggregates. In relation to this, in the last couple of years, two questions have appeared in the prelims. Let's have a look at these particular questions and try to solve these particular questions. First one, the national income of a particular country for a given period is equal to, underline the term national income here. Obviously, national income means what? The total production done by residents of a particular country for a particular time period. So, first statement, total value of goods and services produced by the nationals. The statement is true, but let's eliminate the remaining ones. Sum of total consumption and investment expenditure. No, this will give you part of GDP. Sum of personal incomes of all individuals. If you take all the individuals, then you'll get GDP, but not national income. Money value of the final goods and services produced. Again, GDP, not the national income. So option A is the correct option here. The term GDP deflator is a ratio between, we have seen this, GDP deflator is equal to nominal GDP divided by real GDP. And already I've mentioned this, you can write the same way like in this particular form, real GDP is equal to nominal GDP divided by GDP deflator. This is the formula. Okay. Either this or this, both are one and the same. So the right option will be option A, nominal GDP and real GDP. Okay, so these are the various questions which have been asked in the earlier years with respect to this particular module. So this is the end of the discussion on national income aggregates for you.